Okay, I just wanted to make one final addition to this series. And today is July 9th, 2025. This is direct indexing. So we've added this, and you might say, well, did Jack Bogle miss this part? Maybe, maybe not, probably not, but you do have to consider it. Today's world, it represents a zero ER option. So it's probably not the worst thing you can do in terms of investing. And you can actually match it dollar for dollar in your other holdings that are ETFs or mutual funds, and if you want to do a pure comparison of how they perform over the years. The best way, I think, is to do recurring investments, at least monthly for a year. So that way, if the stocks go up, you're going to make money. If they go down, you're going to have an opportunity to buy more at cheaper prices. The real crux of this, I think, has to be tax loss harvesting. You have to have an eye on that as being an important component to your overall plan. I think the best way to find these is if you look at the holdings of an ETF or mutual fund, you can pull out the ones that you think are the best, whatever you're looking for: earnings growth, profitability, dividend yield, some combination of those. And you can break it down into large cap. The one thing you have to watch out for there is it could be a large component of an ETF or mutual fund that you already own. Mid cap, I think less dollars than large cap, but increasing the number of stocks. And same thing for small cap, should be the least amount of money. The one thing to watch out for, it's kind of hard to get a pure concrete division between small cap and mid cap. And in fact, many of the so-called mid cap ETFs and funds do have small cap and vice versa. So this is our large cap direct indexing, where we've just looked at different sectors and tried to match up a stock that we thought represented that sector and could be held for a long period of time. As I mentioned, one thing you have to watch out for, so Exxon is actually 22% of FENI, so that's a pretty high percentage, and you may find some of these, Microsoft is a very high percentage even in an index of the S&P 500. I think it's something like 6%, so you got to watch out for that, but these are the 10 that I chose. Now mid cap is really an interesting kind of world of stocks, because there are some stocks that are really doing great and they really jump out when you start looking at their earnings, and it's not hard to find them. And it's kind of interesting that even the Fidelity mid cap fund has something like 42 billion. It's got more assets under management there than, for example, FCROX, which is a zero ER total stock market index. So that's kind of interesting. So I think a lot of people are aware that there's some opportunities there. And finally, small cap. Again, if you look through, some of these really jump out at you. I think the financials, I don't know if that's always the way it is, but the financial stocks really jump out at you as ones that are highly profitable. I don't know if that's just the timing of the interest rate environment that we're in, or what's driving that, but they really do jump out at you. And so I probably am overrepresenting them in this list of about 30.